In this video, I'm going to give you an overview of how partnerships are taxed in the United States. We'll talk about what a partnership is, why someone would use a partnership instead of something like an S corporation. We'll talk about the different types of partnerships and partners, why a partnership would have a partnership agreement, what is the difference between a capital interest and a profits interest for a partner, and then we'll also talk about how partnership income and losses flow through to the individual partners, what guaranteed payments are, and what basis is, and what that means to a partner. So let's get into it. What is a partnership? A partnership is just two or more persons who have agreed to carry on a trade or business. Now, it doesn't have to actually be a physical person. You could have one person, another person, and then you could have a C corporation that is a partner in a partnership. Okay, so we've got an individual person here, an individual person here, and then we have a C corporation, and the three of them have together decided to carry out a partnership. Okay, now when you go to set up a partnership, remember when you set up a C corporation, you have to file articles of incorporation in one of the 50 U.S. states. You don't have to do that for a partnership. So there's no actual paperwork that you need to file to legally have a partnership. So you just have two or more persons agree to do business together, you've got a partnership. Now, what can be a partner? As I said here, a C corporation, but also a trust, an estate, pretty much anything can be a partner in a partnership. And that's one of the advantages of partnerships. It's very flexible about who can be one of the partners. Okay, if you remember S corporations, there are a number of restrictions on who can be a shareholder in an S corporation. So that's an advantage of a partnership relative to other entity types. Now, how is a partnership treated for tax purposes? So a partnership is a flow-through entity. That means the profits are not going to be taxed at the partnership level. They're only going to be taxed once. They're going to be taxed to the partner. So the profits of the partnership flow through to the individual partners. Okay, so if a partnership has a $100,000 profit, it's not actually going to pay any tax on that $100,000 profit. Instead, it's going to say, okay, let's look at the different partners we have and say what percentage of the profits interest does each of them have. So if one partner has, for example, a 30% profits interest, they would then be taxed on $30,000 of the $100,000 of profit that the partnership had, whether or not they take a distribution. Okay, so the profit flows through to the individual partners, and each individual partner is going to get a thing called a Schedule K-1. Okay, now the partnership itself, even though it doesn't pay any tax, it has to file a tax return just to show, well, what is the profit? So you have to calculate the profit of the partnership, even though that profit is going to flow through to the partners and be taxed to the partners. So Form 1065, that's the name of the form, the partnership tax return. So that's going to report the profit or loss of the partnership. And then, as I said, each partner is going to get a thing called a K1. Okay, this is a little snippet of a Schedule K1. And so it's going to say what's their share of the income, deductions, and so forth from that partnership. So if you are a partner in a partnership, you are going to receive a K1, and it's going to say what was your share of the partnership's profit and stuff, so you can file your individual tax return. Now, why would you use a partnership? Why not an S corporation, a C corporation, or something, some other form? Okay, a partnership is easy to form. As I said, a C corporation, you have to file articles of incorporation. In LLC, you have to file articles of organization. Not generally all that hard, depends on the state, but there's some paperwork involved. A partnership, you don't have to actually file anything. Now, you should create a partnership agreement. I'll talk about that shortly, but you technically don't have to do that to have a partnership. It's just best practices. So it's very easy to form. As I said, it's a flow-through entity, so the profits are only taxed once. If you had a C Corp, for example, remember that a C Corp, the profit's going to be taxed twice. You're going to have double taxation. The losses can be deductible to the partners, right? So if the partnership has a loss, those losses can be passed through to the partners. There are different, basically limitations. Like, for example, the partner has to have sufficient outside basis. We'll talk about that. There's at-risk limitations. There's a passive loss limitations. We'll talk about those in other videos, but generally speaking, losses can be deductible to the partners. But if you're a shareholder in a C corporation and it has a loss, the shareholders of a C corporation cannot deduct any share of that loss. Now, one advantage of a partnership over an S Corp or a C Corp is you're less likely to take a tax hit if you were to take some property out of the business. So let's say that you had a rental real estate company and there was a building or something and you were trying to take it out of the business. An S Corp, if you are a shareholder in an S Corp and you were to take a distribution of that building, it would be treated as if the S Corp sold the building to you. Okay, so that could trigger gain. With a C Corp, if there's sufficient EMP, it could be treated as a dividend to you, etc. I don't want to go too far down the rabbit hole, but with a partnership, you're less likely to take a tax hit. Now, it's also flexible with respect to who can be an owner, and by owner I mean a partner in the partnership, right? They're really the owners of the business, whereas with an S corporation, C corporation, we call them shareholders. Now, an S corp, remember, there are a number of restrictions. For example, a non-resident alien can't be a shareholder of an S corp. So there's a number of restrictions on who can be an owner of an S corp. But partnerships, anybody can be a partner in a partnership. It's very flexible. Now, another major advantage of a partnership, they can make something called special allocations. And I'll make another video on this, but basically, let me just explain the basics. You could have a partner, so let's just say that they're a 25% partner, okay? You could have it set up where they are 25% partner, and yet they get assigned 80% of any depreciation deductions that the partnership is entitled to. Okay, now you say, well, so this is non-pro rata, right? It's basically they're a 25% partner, but then they get 80% of the depreciation deductions. This is the only form where you can do that, is the partnership. You can't do that with an S corp. With an S corp, any deductions, anything like that, it needs to be pro rata. So if somebody owned 25% of an S corp, they'd get 25% of any depreciation. So what are the different types of partnerships? Well, let's start with a general partnership. A general partnership consists of two or more general partners, and it can't have any limited partners. So what is a general partner and what is a limited partner? A general partner is a partner who is actively involved in managing the business. And a general partner can bind the partnership, which means it can enter into contracts or agreements or make business deals on behalf of the partnership. And a general partner also has unlimited liability. That means if the partnership were to do something bad and it were to be sued, that the people who sue the partnership, they could also come after the general partner. Okay. Now, a limited partner can't be involved in actively managing the business. Okay, they can't do. The general partner is running the business. A limited partner is not involved in making the day-to-day decisions to run the business. They can't bind the partnership to any kind of agreements. They can't sign contracts on behalf of the partnership, and they have limited liability. They can't be held responsible for all of the partnership's debts. Now, a general partnership, as I said, cannot have any limited partners. If you have a partnership that has some limited partners, you would have a limited partnership, right? A limited partnership can have limited partners, but it always has to have at least one general partner. So if you have one or more general partners and you have a number of limited partners, you have a limited partnership. You can also, the third option is to have a limited liability partnership, okay, an LLP. A lot of the large accounting firms in the United States are LLPs. Same idea as a general partnership, except the partners cannot be held liable for any bad things done by the other partners. So remember I said that a general partner has unlimited liability. So if the partnership does something wrong, they could technically be held responsible for that, even if they didn't do anything. So the LLP says, look, we're gonna if I'm a partner in an accounting firm and it's an LLP and another one of the partners commits malpractice or does something that harms a client, I can't personally be held responsible or forced to pay any of my personal assets or anything like that. Now, every partnership should have a partnership agreement. They're not required to have it. You can just start doing business with somebody else and you've got a partnership, even though you might not have created a partnership agreement. However, that would not be a good idea because the partnership agreement, the purpose of it is to say, okay, what are all the rights of the different partners? What are they entitled to? What percentage of the profits? What percentage of the capital? Capital interest, by the way, is like if the partnership were to be liquidated, the assets and so forth, like what share of those net assets are you going to get? Okay, so you got the profits interest, which is the share of the partnership's profits, and the capital interest is the share of the partnership's net assets. So the partnership agreement would spell all this out and say, look, you're entitled to 30% of the profits. So then if there's some kind of dispute between the partners, you look and just go to the partnership agreement and say, well, look, it says I get 30% of the profits. Okay, so this is very helpful if there's a dispute, which often happens, about what percentage of profit or what if the partnership is sold or liquidated or something like that. Okay, so this is something every partnership should have, but you technically don't need it to have a partnership. Now, I mentioned the capital interest and profits interest. These are very important concepts, so I just want to make sure that you fully understand that. So the partnership has assets, right? So you've got this partnership, and maybe person A, person B, person C, they all get together and they say, we're going to have this partnership, and they each contribute some assets, like cash, building, land, whatever. They contribute. So there's these assets held by the partnership. Now, what if the partnership were to be liquidated? What if they're like, you know what, we don't want to, we don't want to have this partnership anymore. Let's just, we'll each just take our share of the net assets of this partnership, and we'll go off in our separate ways. Okay, so if it's liquidated, we need some way of determining what percentage does each person get. Okay, and then the profits interest, that's when the partnership is ongoing, it's doing its business operations, it has, let's say, a $200,000 profit. If you are person C, how much of that $200,000 profit is taxable to you? Okay, if you had a 30% profits interest, then you have $60,000 of income, right? 30% times the 200,000. Now, you might be wondering, the capital interest and profits interest, are they always the same, or could they be different? Well, you could have a situation where you could say, all right, my capital interest is 30%, but my profits interest is 50%. That's fine. That's fine. You can have that. And where would that be spelled out? In the partnership agreement, right? You lay that out. So sometimes it would be the same. It would be like, no, it's 30% and 30%. But yes, you can have situations where the capital interest and profits interest are not the same. Now, getting a little more complicated here, speaking to the partnership income and losses, guaranteed payments, basis. So basically, the partnership is going to file that Form 1065. They're going to have all their income. They're going to have their deductions. They're going to come up with their profit. Okay, so the profit of the partnership. But remember, the partnership itself does not pay any tax on its profit. Okay, so what happens is this $200,000 of profit that's going to flow through to these partners. We're going to say, oh, you're getting 30% of it, you're getting 40%, whatever, right? So they're each going to get their K1 that's going to say their share of the partnership. Now, let's say you have 30% profits interest and there's $200,000 profit. You're going to be taxed on $60,000 of income, whether or not that partnership actually gives you $60,000. That's called a distribution. Like, let's say they were to give you $60,000, like, hey, this is great. I want my $60,000. Give me $60,000 cash. Whether or not they give you $60,000 cash, they could give you nothing. And just like you're just taxed on that 30% of that $200,000, even though you didn't receive anything. Okay, so bear that in mind. Now, furthermore, that $60,000, what the K1 is actually going to do, there's these things. So basically, there's things called separately stated items. So it might be that some of this profit here, some of it is just ordinary income, but some of it is capital gains, right? So it will actually break that out separately and say, like, okay, here's your portion of ordinary income, here's your portion of capital gains, capital losses, and so forth. Okay, so that's if you hear about separately stated items, it's just breaking out things other than ordinary income. Okay, because the partners in the partnership might be taxed differently on net capital gains, and so they need to break that out, and they're called separately stated items. Okay, now, each partner could also be taxed on any guaranteed payments. So if you're new to partnership tax, you might not have heard about guaranteed payments before. So really, there's two types of guaranteed payments. Okay, so one type of guaranteed payment is for services that were performed by the partner. So the example of this is basically just think of it as a salary. Okay, let's say I'm a partner in a partnership and I'm doing work for the partnership. I'm not an employee of the partnership. I'm a partner. But if they're giving me $2,000 every week and it's just like, hey, that's his regular payment for the work he's doing for the partnership. Okay, that's a guaranteed payment for services rendered. So I am going to be, that guaranteed payment will be taxable income to me. Okay, and I'm going to have to pay self-employment tax on it as well. The guaranteed payment will be deductible to the partnership. Generally speaking, and there are certain instances where it's capitalized and stuff, but I won't go into the details there. But generally speaking, the guaranteed payment would be deductible. So that means it would have been subtracted in calculating that $200,000 profit of the partnership. So if I would get, let's say, going back to this example here, let's say that I had a 30% profits interest and the partnership had $200,000 of profit. And then in addition to that, there had been a guaranteed payments to me during the year of, let's say, $20,000. Then I would be taxed on my share of the partnership income, 30% of that, so $60,000. But I would also be taxed on the guaranteed payment that I received. Okay. Now, again, that guaranteed payment would have been deductible, like the partnership would have deducted that in calculating that $200,000 with certain exceptions. Now, The second type of guaranteed payment is for the use of the partner's capital. So that is like, think about if I as the partner, let's say I'm not doing work for the partnership, but I'm like, you know what, I'll give the partnership $500,000 or something. And normally you would get interest, right? So think about that as being similar to interest. Now, if I'm getting payments, guaranteed payments from the partnership, if I'm getting guaranteed payment for the use of my capital, so I give them money and it's like similar to interest, I will have to pay federal income tax on that, right? That's taxable income to me. However, that would not be subject to any self-employment tax, okay? So guaranteed payment for the use of your services, there is subject to self-employment tax, where guaranteed payment for the use of the partner's capital is not subject to self-employment tax, but they're both subject to regular federal income tax, okay? So went through guaranteed payments. Now, basis. This is very complicated. I'm just going to give you a brief overview of this. So each partner is going to have this thing called outside basis. This is their tax basis in the partnership interest, okay? So let's say I contribute $100,000 cash in exchange for a partnership interest, for a 30% interest in a partnership or something. Then my basis in that partnership interest is $100,000. Why do we care about my outside basis? There are several reasons. I'll just give you a couple. So number one, I talked about limitations on the deductions you can have when the partnership has losses and they pass through to you. One of them is you can't take a deduction if you don't have outside basis. If your outside basis is zero, you're not going to be able to deduct any losses that the partnership has. Now, there are things you can do to increase your outside basis. You could take on a greater share of the partnership debt. Okay, so if you increase your share of the partnership debt, that will increase your basis. You could, there's other things I won't go into all that. We'll make another video on it. But basically, this is cap. You can't take deductions beyond the amount of your outside basis. Okay, so if you have a $20,000 outside basis, you're not going to be able to take more than $20,000 deduction from any losses from your partnership interest. Also, we need to know outside basis, because what if you go to sell your partnership interest, right? That is going to be used to calculate the gain or loss on the sale of your partnership interest, right? So that's outside basis. You'll also hear about inside basis. I know this is very confusing. Hang with me. So the inside basis is the partnership's basis in the assets that it receives from the partners. Okay, so let's say that I contributed land to a partnership, and the land, before I contributed it to the partnership, it had a basis to me of $10,000. Like, that's what I paid for years ago. It had a basis of $10,000, and then it had a fair market value, or let's say fair value. I'll just abbreviate FV here. Fair value of $50,000. Now, when I contribute that land to the partnership in exchange for the partnership interest, I'm not going to be taxed on the gain here, because you might think, well, $40,000 or $50,000 fair value minus $10,000 basis. Do you have a $40,000 gain? No, there's a thing called Section 721 that will postpone the gain here, so I don't have to worry about that. That's another issue. In any event, getting back to the issue of basis, my outside basis in my partnership interest, if all I contributed is this land, my outside basis would be the $10,000. That would be the basis of the property I contributed to the partnership in exchange for the partnership interest. But then the partnership would now have the land, and the partnership's basis in the land would also be $10,000. Okay, so the partnership has a basis in the assets it receives from the partners, and that's the inside basis. Okay, and then I have outside basis, my basis in the partnership interest, right? Because I could sell my interest in the partnership. Now you might say, well, is it possible for the inside basis and the outside basis to be different? Yes, there are a number of things that could make that happen. For example, let's say I contribute this land to the partnership, and then I later sell my partnership interest. I sell it to somebody else for $50,000, right? I sell the partnership to somebody named Tom. Okay, so Tom comes in and he now has a basis in the his outside basis is $50,000, but then the inside basis of the land is $10,000. So his inside basis and outside basis would differ, and there's actually a thing called a Section 754 adjustment that you can make. It's an optional adjustment. I'll make a video on that. We'll talk about that as well. Okay, now, finally, one other thing I wanted to just briefly mention is I talked about special allocations where you have non-pro rata allocations where you say, this partner has 25% capital interest, 25% profits interest, but we're going to give them 80% of depreciation deductions, for example. To do that, there are a number of things you have to do. You have to show that the allocations have substantial economic effect, and there's a number of requirements there. But one of them is to keep track of something called a Section 704B capital account. So don't get confused. Section 704B capital account is actually different. Okay, it's different from a partner's outside basis. Just one way I'll tell you it's different is, remember I said if I contributed land to the partnership and it has a basis of $10,000 and a fair value of $50,000. So my outside basis, and so my basis in the partnership interest is initially going to be $10,000. Now that'll change as the partnership earns income. My share of income will increase my outside basis, and so forth. Okay. I'll make a video on how outside basis changes and how to calculate it. But right now, the difference between outside basis, so your outside basis, that is increasing when you contribute this land. It increases by the amount of your basis in the land when you contribute it to the partnership. Your 704B capital account, however, would increase by the fair market value of the land that you're contributing, not by the basis. Why? 704B capital account is trying to track basically your equity in the partnership, which would then be used if you were if the partnership were being liquidated or whatever, thinking about what share of the net assets you would get. And these are complicated topics, so hang in there. And I'm going to make a number of videos to describe each of these in more detail in the weeks to come.